Thoughts on whole life insurance as an alternative to banking. I've had term life insurance for almost 20 years now. It covers my wife and kids in the event of the inevitable. But the term is almost up and I met with a new insurance agent today. He really tried pushing universal life insurance on me, which really confused me. So I came home and started researching. Seems universal life is a shit product. But then I came across strategies for using whole life insurance as a great alternative to a savings account. Your family gets a death benefit in case you croak. You earn at least 4 to 5% on your money and you can borrow that money anytime you want, both tax-free and with no penalties. You pay back the loan at the same rate you're earning on your cash value, so it's basically a wash since you're borrowing money from the insurance company and not directly from your cash value. Seems that at the end of the term you can cash out all your dough free on any tax. Plus that money is untouchable. No lawsuits, liens, bankruptcies or ex-wives can get to it. I really like the liquidity of it. If I want to grab some money to grow my business or for a down payment on a house, I can. Just like I would from a regular savings account. I'm just earning 5% instead of 0.5% and my family get $1 million if a piano falls on my head. I don't recall mentioning this kind of product as one of his investment vehicles but I'd be curious to know his thoughts on it as well as everyone else. S. Thank you for your time. I don't know anything about life insurance, but I am very much interested in this piano business of yours. Maybe we can work something out. I am a financial advisor based in Singapore, so I will discuss in the context of Singapore environment. I hope I can offer you more points to consider that you can do more research to form an informed opinion. Universal life insurance generally has high distribution cost, more commission for the sales force and hence less return for you. I generally recommend customers to look at other whole life insurance products if they are into whole life insurance. Yes, you can borrow money from it. But at 5.5% interest here in Singapore, it is not attractive for a secured loan. You get less than 2.5% from the bank by pledging your property. Yes, it has tax advantages in US, but I would not elaborate further because in Singapore there is no inheritance tax or capital gain tax on investment. Did your agent tell you a 4 to 5% return? Honestly, that's too high. It is more like the yield on death benefit rather than surrender value. In the benefit illustration, investment return is the yield for the insurance company, not for you. Look for term yield to maturity printed in black and white. It will say at age 70, the yield to maturity is 20%. Do internal rate of calculation if unsure. When picking a whole life insurance, make sure you ask yourself, are you looking at wealth accumulation or protection? Typically the high protection products have slower cash value accumulation. Low protection value products have cash value that gets accumulated quickly. My recommendation has always been this. Do not look for insurance as saving or liquidity. Go for whole life insurance for coverage and legacy planning, death benefit at natural death. If you want liquidity, just of cash in bank. If you want saving, buy a pure saving endowment or investment product. It is much easier for planning. You do not have to worry about liquidating your saving plan but unnecessarily reducing your coverage. If the goal is just the death benefit and legacy planning, wouldn't a term life policy be better and cheaper? You can get way more death benefit for way less than a whole life policy. Also, is it true that at the end of a whole life policy, you can't get both your death benefit and your cash value? That means THST when you die, the hand over the death benefit, but all the savings you put into the cash value portion they get to keep. Learned that from Dave Ramsey just today, lol. If that's the case, then F that SH. I'll find another place to park my money. Yes, you cannot get full cash benefit and death value. Most policies allow you to withdraw the accumulated bonus portion without diminishing the death benefit. Term plan works best when you know the time horizon exactly. For example, you know when your child is going to graduate from university and be independent. You just don't know when you are going to die. You buy a term plan until you are age 80. What if you live till 81? At 80, do you have to force yourself to commit suicide if you are not dying? Low cash value whole life plan works better in legacy planning because you do not have to time your death. It's basically pay me when I die. If you do the math and compare buying a term plan until 100 years old versus a whole life plan, the whole life plan is more economical. Do not get sucked into the guru hype and ignore the details. When they say buy term only, they usually assume 1. You do not want to use insurance to do legacy planning. 2. You will do better in investment versus whole life insurance cash value growth. I agree if you have time to manage and the skill to do it. That's why I advocate low cash value high protection whole life a plan. But people like Dave Ramsey give misleading bullshit like an expected 12% return. Their forecast for equity growth as a reason why you should spend as little money as possible on insurance. Study shows that even though equity growth has been stellar for the past 30 years, people who did the buy term and invest the rest did worse than whole life insurance buyers. It is because they spent the money on consumption and didn't invest properly. So it goes back to the previous point about having the discipline. You will never hear about Dave Ramsey criticizing mutual fund fee and promote ETF as an investment. Why? I leave that for you to research if you are interested. Don't whole life policies have fees as well? Ramsey claims the first 2 to 3 years are all fees. Either way, I'm not sure I like the idea of paying into an account that I'll never get my money back on. Could I buy term and rewrite the policy every 5 years to extend it an additional 5 years? Would still be cheaper than whole life premiums 20 years from now, I'd assume. And after fees from the whole life policy, wouldn't my rate of return on the cash value be lower? Probably not the 4 to 5% they advertise. Wouldn't it be about the same as putting my cash in a 2.5% online savings account? So much information to process. My life insurance is actual wealth left to heirs through a trust. I don't use life insurance, although I think it is a good idea for a family just getting started. If you have generational wealth, then I don't think it's necessary, as proper estate planning should take care of life tragedies. So you don't see it as a vehicle for legacy planning, correct? Because that is how whole life policies seem to be marketed. Would you say cheap term life insurance is the way to go? Yes, if I was young and with a family to provide for. Yes, the fees seem cray-cray, but aside from that, I just can't wrap my head around why I would pay money into an account that earns 4% interest, but that I will never truly own. Because when I die, my wife will get the death benefit. But what happens to all that money in the cash value? If I buy term and have 500k in a regular savings, I at least know my wife and kids will get the death benefit plus the 500k in our savings account. But if that 500k was in a cash value policy, where does it go? In the insurance company's pocket? If so, that doesn't make sense to me. At all. Why would anyone literally give away their money? Am I thinking about this correctly, or am I missing something? No matter what interest you pay me on my cash value, my family will never see that money after I'm buried 6 feet under. And let's say I piss away half that 500k in a savings account due to inflation, and my wife only ends up with 250k worth of buying power in 20 years. That still beats not getting a penny of that money back from the insurance company when I die. How can this be seen as a sound strategy? I would really need someone to hold me by the hand and baby step my ass through each number in order for this to make sense to me. I've heard universal life insurance is better for tax purposes, but I have not looked into it too much. Yes, there are cost and charged embedded inside the product. Look at total expense ratio in the benefit illustration. If you buy term and renew, there will be new underwriting for the new application. As you grow older, when illness catch on, there will be a time when you are no longer accepted, or the company will charge you extra loading for the same coverage due to health condition. If you are looking for insurance products for saving, I recommend endowment policy. They have high cash value with minimal protection value. Whether it's suitable for you depends on what you want. Are you looking for liquidity? Insurance products are long-term commitment and they are very bad in liquidity. If you are looking for investment safety, then it is suitable. They usually have a guaranteed surrender value upon maturity which is higher than the amount invested. Why would I put so much money into paying off my house? When I sell it, the bank keeps all my equity and all I get is the sale price. Depends on the expertise and skill of the investor. If someone has time and skill to do his own investment and trading, just open a NIB brokerage account. If someone is knowledge about investment and prefer low-cost buy and hold strategy, just buy Vanguard product. There is a larger segment of population who prefer safe and unsophisticated way of investment. They will go for capital guaranteed life insurance products such as endowment plans. Lots of them had bad experience getting burnt by penny stocks, and they quickly swing their future investment to the safe side. If you compare the cost of buying an endowment policy versus doing your own investment, the key thing is the total expense ratio being charged by the endowment product. Good products have a total expense ratio below 1%. When you buy an endowment product with a policy term of 10 years, for example, what you really have done is giving your money to an insurance company. The insurance company then outsources the investment to an external manager to invest in 30% equity and 70% bond globally. The insurance company promises that they will guarantee you the capital no loss after 10 years. If the investment made an annual rate of 5%, for example, what you will get is 4.2% if the total expense ratio is 0.8%. So assuming you invest in the same things for yourself through a broker, 30% equity, 70% bond, it will cost you your own time to do the research and trading changes as you see fit along the 10 years. The capital is never guaranteed. That is the downside of investing by yourself. The good thing about the DIY approach is you save on the cost charges paid to the insurance company. But keep in the mind that small brokerage fee does exist also, depending on how often you make adjustment to your portfolio. The real difference is liquidity. Your capital is not tied up for 10 years. You can sell anytime as fast as a mouse click if you do it by yourself. My experience is that the biggest drawback in insurance company product is liquidity, not the cost. In Singapore, where I work, there are many insurance companies competing for the same pool of customers, and the cost structure of the products are fairly competitive. The argument about using cash value as a loan is never attractive here in Singapore. Most people who look into that option are business owners, and most of them have private properties that can be pledged to the bank and get a much lower interest rate. It is like 2.5% versus 5.5%. On the term versus whole life argument, my view is it doesn't really matter as long as you keep your protection and saving into separate products. Protection you can buy term until 65 years old, for instance, retirement age. You can also choose a whole life that pay you when you die. This is for customers who want to leave a bit of money for the children using insurance. Choose the whole life, a plan that have negligible cash value so that they have high protection death benefit. Invest in whatever you want. You can invest in a pure saving or investment products through an insurance company, or do it yourself by mutual fund and ETF through a broker. The problem arises when some people want to address protection and investment using one product, such as whole life insurance. They seek protection from the product and meanwhile uses it as a saving tool for the future. So when they need the money they have to terminate the plan. When they terminate the plan the protection is gone. It creates difficulty in planning. I do not believe that certain product types by design are inherently superior. If you buy a term plan until 65 versus a whole life plan minimal cash value, of course the term plan is cheaper because the whole life plan guarantees a payout, and basically it is like you buying a term plan into age infinity. When it comes to financial products the devils are in the details. Products with high distribution cost and expense ratio are universally bad regardless of how they are being branded. It just means that too much of your money will being used to pay for administration, manager's fee and sales force commission. This is exactly what I'm figuring out about whole life insurance as I do more research. This article does a great job of explaining it in terms I can understand. Don't get too influenced by online opinion. Listen to all but make your own judgment. Financial products are essentially contracts. This is no such thing as good category of products and bad category of products. Whole life insurance as saving was popular before the 80s because equity market was bad. Stock market was dead water. It was only after the bull market rally for the past 30 to 40 years that we began to hear buy term and invest the rest. But keep in the mind that it was based on a projection of high economic growth. Low inflation since the 80s, the golden era of globalization. I have priced both ways and had salesmen tell me why term is a waste of money and why term is awesome and whole life is a ripoff. Honestly I think both suck as most people pay into them for years and then either stop paying and let them lapse wasting all the money, or I do into a new policy and again wasted all that time and money. I also know a lot of people get suckered into policies with massive loopholes that they aren't aware of and families get screwed in the end. Real life example of a bad policy and people getting screwed. My wife lost her grandfather who on his deathbed told us where his policy information was and that no one in the family would ever have to worry about money again. When we went through thousands of stacks of papers, please for the love of God put your policy somewhere that it can be found. I finally found his $1 million life insurance policy. I didn't even want to share it with them at that point as it was a $1 million policy, but only if he was killed in a public transportation accident. He got $5,000 if he was killed in a normal auto accident, and $3,000 for natural death. He had paid $20 a month for 25 years for this policy thinking it was a $1 million policy and in the end got $3,000. They were very deceptive in marketing it because at the top it was big and boldly written that it was a $1 million policy with a tiny little. He paid $6,000 to recoup $3,000. That said, I have a wife, daughter, and another daughter due in 5 weeks, so I have $1 million in term life just as a security blanket for them as I do not have that generational wealth yet. Your wife's grandpa bought an accident plan. No way that a 1 million life insurance can be so cheap. Lol. Most insurance companies have online access now. Keeping paper record is no longer necessary. The benefit illustration will publish the average historical return in the past. For my company the past 10-year average was 4.81% for investment return. Based on at a 10 years plan yield for customer will be around 3.3 to 3.4%. But a 25 years commitment will generate 4% yield for the client. If you know how to do your investment and have the time to do so, then sure Scotch you should be doing it on your own to save cost. If I'm remembering correctly, I think I read that you deal in real estate quite a lot. What do you think about the housing market? Think we're due for a correction? I own a property in Washington, D.C. that is just now getting back to the value it was at before the 2008 crash, and I'm thinking of selling before another crash. Would hate to wait another decade to recover from a downturn. The neighborhood it's in is about to start booming with tons of development, so there's definitely room for more growth. But I'm just not so confident that this market will be able to stay so generous for another year or two. If I'm remembering correctly, I think I read that you deal in real estate quite a lot. What do you think about the housing market? Think we're due for a correction? I own a property in Washington, D.C. that is just now getting back to the value it was at before the 2008 crash, and I'm thinking of selling before another crash. Would hate to wait another decade to recover from a downturn. The neighborhood it's in is about to start booming with tons of development, so there's definitely room for more growth. But I'm just not so confident that this market will be able to stay so generous for another year or two. Great insights. I think we're going to sell it and pay off all our debt, including the mortgage of the home we currently live in. It has been a golden goose for us for over a decade now. We've financed 2 cars with it, got some cash out of it, and recently rolled in some student loans into it. I think it's time for to lay its final egg for us by making us 100% debt-free. I feel so thankful to have had it. If that bothers you, buy a return of premium rider. You'll get all the premium you paid back, plus the death benefit, if you die within a period of time. The extra cost is your own money. You're saving money as part of your death benefit. Whole life costs less if you're buying it for, well, your whole life. Early on, more of what you're paying is premium for the term life part of the policy. Later on, more of what you're paying is just your own money going into a sheltered account. Just want to reiterate this because people often don't understand it. The cash value portion of whole life is you're not losing the money. You're putting it in an account to fund the death benefit, or getting it back if you cash out early or die late. If you bought the same amount of insurance in term life, for the same period of time, e.g., from age 30 to 80, it would cost you more by the end. Term is not cheap anymore once you're old. That might or might not be okay with you. Maybe you only need life insurance for another 5 years, in your opinion. In that case, whole life is not the tool. Both types of insurance are reasonable options depending on what they're trying to do. I've looked into whole life insurance. And it does sound like a good investment or insurance policy. I've heard that you can pay a one big lump sum like $500,000 or $1 mil. And then have it grow at around 3% per year, and take out a loan against the policy, interest-free, without hurting the compounding effect. I've not heard that you need to pay $5K 7K every year in order to keep it active. I suggest you speak with some experts, mate. Single premium policies requires you to pay a lump sum at start and no further premium payment is required. Regular premium policies require constant payment until the premium term is over. It depends on the product specification. If you were worried about becoming a litigation target, you could stuff some money into single premium whole life. The cash value and death benefit are sheltered from litigation and creditors. Even if they take everything else, you have paid for life insurance with no premiums due. It guarantees your heirs get something. Or you can borrow the cash value. Not that I'm buying one, or selling one. Downside. It becomes a modified endowment contract mech in the US, which has less favorable taxation features than regular whole life. Why do you say it's more expensive? Do you mean you pay more upfront? Anything that isn't financed over time has this feature. When you pay cash for a house, you pay $200,000 on day one. When you finance it, you pay less on day one, but more over the amortization period. Did you calculate the calories you burn writing 480 checks instead of one? Kidding. Fair enough if you have a theory to base it on. Usually single premium policies do not have high protection. They are more geared towards cash value. So a fair comparison would be cash value of single premium low protection versus the cash value of a regular premium policies. Single premium policies, according to my experience, actually accumulates return faster. I am in the business doing comparison every day. The reason is simple. The company pays you more when you are willing to commit your money for a longer period of time, sacrificing liquidity. Think of it as having a 3 years fixed deposit saving versus having a 1 year fixed deposit saving and auto roll over for the next 2 years. The former will generate better interest. The next point is a bit more in depth for those folks interested in the finance business. Insurance companies love selling regular premium. Sales agents have contracts indicating the minimum amount of regular premium sales they have to make every year, but never on the single premium ones. The reason is highly behavior. Most clients suffer from sunk cost delusion. They tend to surrender their single premium policies after it has broken even and made money. But having your policy break even at year 6 and surrender it at year 7 for a profit is an enormous bad decision. But most people have poor concept about time value of money, and they will keep doing this. This leaves insurance company at disadvantaged scenario, because after the client surrender his policy, he has to make a new sale to continue the business volume for a product that is ideally designed for a 15 to 20 years time horizon. This means new administration and distribution cost, a problem that insurance companies do not have to face for regular premium policies. That's stupid. Very ignorant statement. After 30 years you could have dividends or PUAs cover the premium. You could also schedule the policy to be contractually paid up after a certain number of years. There are also mandatory non-forfeiture options. Assuming dividends are used to buy PUAs, the dividend in year 30 should be about twice as much as the premium, and the reduced paid-up non-forfeiture option should be about 25% higher than the original face amount. You might want to cool the inflammatory remarks. Is hands down one of the smartest guys on the forum. As far as life insurance policies are concerned, there isn't much out there I like less as an investment than some blowhard telling people what they're ignorant about. This seems almost intentionally complicated. Customers are probably ignorant by design. Smart people don't typically make ignorant statements. If he's as smart as you say, I'll recharacterize what he wrote as deliberately misleading. Great way to introduce yourself on the forum. Can you enlighten us as to why? Whoever told him that was stupid. All types of life insurance have the same tax treatment. I heard a 401k has better tax treatment than a 403b. I haven't looked into it, but I thought I would post about it anyway. It is not fair to compare insurance products with the performance of equity index, because most of them invest in a portfolio that is more focused on bonds. If you believe that most of your money should be in equity that make you 10% a year, it is largely a risk preference. What I am saying is, if you do an apple-to-apple comparison, and find a product provider with competitive fee structure, it can save time and provide less risk for a lot of people who are not interested in doing their own investment in the wild, wild west. I just do not agree with the Dave Ramsey BS that insurance is ripping everyone off and everyone will get 12% putting their money in US equity. Dave, how about I give you the money and you guarantee me 6% return with your property as collateral, and you get to keep the rest of the profit? Don't expect Dave having the balls to do that. S&P Composite is basically pure equity. What I am saying is, your disagreement with insurance products is largely in you believing in putting your money in pure equity and wait for them to appreciate. Absolutely nothing wrong with that. My defense of the industry is as follows. Insurance products invest in a mix of bonds and equity, more heavily in bonds. If you compare insurance products versus someone investing in a similar basket of bonds and equity, insurance products do not really charge you a high fee and diluting your return much, in comparison with the time you saved and the capital guarantee it provides. The funny thing is, I don't really disagree on your view in investing that much. I actually advised young clients to put money in equity at first, but they insist to buy insurance products. I shut up, then do the deal. But just bear in mind that not everyone is the same. I think your view is better repositioned, that as I do not like insurance products because they invest in instruments that are too safe, whereby I can invest in riskier products and have a long investment time horizon and eventually get a superior return. Well then I do not see any issue with that. Back to the question on property financing, Singapore banks offer floating rate of about 2.5% per annum. Fixed rate would be higher, but the banks generally do not give fixed rate more than 3 years. If you can offer 6% on secured lending here, it will be the money chasing you, not the other way. Could you elaborate more the real estate lending in your area? Woo man. Discounted cash flow. Net present value. Double rainbow. What does it mean? Ian? You must have taken at least one college course. You might even own a financial calculator. We're not worthy of such an intellect. So smart and unsuccessful, and still have the time to write such a long post to me? I'm honored. I'll give you the benefit of the doubt. Please show me where I compared insurance to an investment. Alternatively, please explain why you said that whole life requires that you pay forever. It was either ignorance or deliberate misrepresentation. Personally, I don't care whether investing your money in real estate or the S&P 500 will give me better return or not. What I want to know is, can I buy a whole life insurance policy, pay only one side $500,000 or $1 mil, and never have to pay into it again, have it grow for 30 to 60 years, and in the meantime be able to borrow against the insurance policy's cash value without the net death benefit going down without losing the power of compounding so long as I repay the loan with interest. That's what the whole infinite banking is about. Which assertion are you referring to? It seems that way because it is. It's why we seldom recommend whole life policies. It's very difficult, if not impossible, to determine before signing up what % of your premium is being allocated to death benefit versus expenses versus cash value. Now there are some circumstances that warrant it, such as ultra-high net worth individuals who are looking for a supplemental instrument for gifting to heirs, but I would call this the exception rather than the rule, as these folks don't need cash in the meantime, so higher premiums nor a longer timeline don't affect them. As the article below mentions, you need to pay into these policies for roughly 15 years before they begin to be the better choice. To your points, the chart below is one of the better comparisons I've seen comparing different options. Obviously this is leaving out the S&P alternative, but figure $5,000 or year for 40 years at 10% probably gets you about $2,500,000. Don't tell that to my golfing buddy who runs PIMCO's investment credit bond fund, which has returned 7.5% since 2000 while yielding 3.5%. Bottom line from everything I've ever studied and learned is that the policies have benefits for the right people, but for probably 95% of consumers, they are not the best choice. Underwriter here, studying Chartered General Insurance but actually studied actuarial for life in UNI. My GM always argues with me for taking whole life because of following no matter what anyone says. Number 2 is correct. If not, insurance companies would not make money. Independent life and health agent here, thought I'd clear up a few things. Whole life has its place, but do not buy into this infinite banking nonsense. There are much better returns out there, and you are trading that for the death benefit and tax treatment. To protect a new family, I usually recommend level term. It's cheap, easy to understand, and gets the job done. Dave Ramsey makes a lot of money from term life insurance advertisers, so his advice is biased against whole life. There are single premium whole life policies where you make a single upfront payment and get a fixed or variable return depending on the type of policy. You can borrow from the cash value like with regular whole life, and the outstanding loan plus interest would be deducted from the death benefit. I've spent a little more time looking into this whole life insurance stuff for family banking, and correct me if I'm wrong, but you can buy a high cash value mutual whole life insurance policy that allows you pay premiums for around 7 to 10 years, and after that you can decide to stop paying into it because You also earn dividends because it's part of a mutual, and those dividends can be used to cover your premium costs. On top of that, you're able to borrow against the cash value. However, you must pay it back with interest, ideally one higher than 5%, and keep the policy intact. And should you fail to pay back the loan, then what you owe will be deducted from your policy when you pass away. This is a very interesting concept to me as I continue down the path of financial freedom. To set the stage here, I am about one thing and one thing only: finding the most efficient way for me to earn the highest risk-adjusted return on my capital possible. I get what is saying here. Historically speaking, the S&P earns 7 to 8% per year on average. That far outweighs the 3 to 5% a whole life policy offers. So in theory, and I haven't ran the math myself, but the combination of term life insurance plus investing the savings versus whole life premium into the S&P would offer superior returns. The first thing I noticed here is that the 7 to 8% is pre-tax gains versus the 3 to 5%, which, and again I'm no expert, whole life return, which is tax-free. Post-tax, it would seem that the returns are very similar in nature. Another thing to consider are the diversification benefits here. A portfolio that encompasses both direct equity investing and whole life investing likely offers diversification benefits that aren't being touched on here. Finally, the loan aspect of whole life is intriguing. I can take a loan out of the policy while not impeding my returns. This compares to direct equity investing, whereby if an emergency arises or I want to invest in real estate, I need to sell my position, which comes with tax implications, and I give up the 7 to 8% annual returns. Please correct me if I'm wrong with any of this, as again I'm no expert. Assuming I'm right, it seems like there are some hidden benefits to whole life that this debate is missing. The only other cost here would be opportunity cost. I could take the $50,000 I've paid into this policy that's earning 4 to 6% and put it into an income-producing rental property, which in all likelihood would yield me much more attractive returns and offer similar-ish characteristics. Home equity line on portfolio, cash or refinance. For me, all roads lead back to real estate investing, but I'm also starting to consider diversification benefits. Agreed. Just read a pretty telling article that backs what you're saying. The upfront fees kill your IRR. The article I saw suggested that the cash balance at the end of year 7 was about 50% of what he paid in premium. That doesn't seem like a sound investment to me. Not to hijack the thread at all, but where does one put assets while accumulating for a real estate purchase? I save all year and then once I hit a certain hash I can allocate to RE, but how do I maximize my gains while I'm in the accumulation period? Sorry for resurrecting an old thread. I want to chime in because I'm a regular guy, not a financial professional with a whole life policy. My policy is structured for cash value. Its intended function is to act as a savings account more than anything else. The policy costs me money for the 7 years. If you ignore that I am also buying the death benefit for my young family, it starts showing a positive return in year 7 and then increases by a guaranteed 4 to 5%. This is ignoring that it's a mutual company that pays a non-guaranteed dividend on top of the guaranteed returns. At some point around year 10, I think, the expected dividends should cover my premiums. I'm not interested in maximizing my return or building wealth through investment. I'm interested in safety and minimum risk. My choice to use a whole life policy is largely influenced by my personal politics or something like that. I don't trust banks, I don't trust Wall Street. If I could, I'd keep all of my wealth in precious metals and similar assets. Since I do need financial services, I prefer to do business with a mutual insurance company that has been around since the 1800s. I like that there are no tax complications to figure out with my policy and there are no assets, just a contract that guarantees I can borrow money at a prime rate, anytime, no questions asked. Also, repayment of the loan is totally up to me. I don't need to repay if I don't want to, i.e. I can spend it on retirement or emergency. Don't have to wait to die to cash out. I'm sure there is more money investing in equities, but that's not what I want to spend my time doing, and my goal is just to have an alternative to a savings account so that I have access to funds for entrepreneurial projects. I want to mention a concept I didn't see in the previous discussion. All money you spend is financed. You either borrow and pay a fee, or spend your savings and forego earning a fee. With the whole life policy, it's like savings, but you never diminish your principal like you would with a savings account. Well, my too. I've been researching building your own bank as well. Everyone comparing using a life insurance policy as a bank and comparing it to investing seems to be missing the point. The point is to A. Be able to finance anything yourself, on your repayment terms, and capture some of the interest that would otherwise go to a bank. B. Have a vehicle that guarantees growth of investment. Yes, there are fees up front, but typically by year 7 the policy will pull ahead compared to bonds. C. Not lose out on the opportunity cost of spending money. For example, buying a car in cash means the cash cannot appreciate. D. Tax advantages. Protection from creditors or being sued, with a perk of death benefit. E. After a long enough time you can make the policy pay for its premiums. One thing I've recently been wrapping my head around is that there is no guaranteed rate of appreciation of the cash value of a policy. But that it will appreciate is guaranteed. Cash value is tied to the present value of the death benefit. It's not appreciation based on any securities, rather it's appreciation based on inherent value of the policy itself. It's kinda like bonds in a sense. The present value of a bond is a reflection of what a bond will be worth when it matures. The cash value of a policy is a reflection of what the policy will pay out upon death. I'm interested in if anyone else has actually implemented this. I find it super interesting that the super rich take advantage of whole life insurance policies too. Your point C is one I try to point out to people. When you take a policy loan you don't diminish your principal. I will look at my illustration and try to think about your question regarding cash value appreciation. I believe my illustration is based on the assumption that I max out paid up additions, with a guaranteed appreciation of 4%. Then my cash value is a combination of some percentage of my normal death benefit, plus 100% of PUR. The PUR is what makes the whole thing function as your own bank. I will chime in here and mention some of what I do with and for clients. This is informational only and I am not trying to change anyone's mind or sell anybody anything. I don't care if people agree or disagree with this approach, but figured I might be able to add some clarity for those fortunate enough to have built substantial wealth or on the road to doing so. I have found much value from others' posts here, so perhaps I can share some myself. In this environment of huge deficits, damn near close to $28 trillion and climbing, we feel higher taxes, income, cap gains, estate are inevitable since our politicians will never stop giving out handouts and will definitely not end Social Security, Medicare, Medicaid. So, we seek out any tool available to plan and mitigate taxes whenever possible. Permanent life insurance has some of the best tax treatment of any vehicle, tax-deferred growth, income tax-free death benefits to heirs, and tax-free distributions since they are taken as loans. Notice I said permanent, not whole life, which is only one form of permanent life insurance. There are two areas where we use life insurance other than coverage for untimely death: one, massively overfunding policies to accumulate large amounts of cash taken out tax-free 10 to 15 years later, allowing for some great compounding for a variety of purposes, retirement income, travel, long-term care needs, etc. The products we use are more flexible than whole life, allow for some nice potential upside linked to various equity indexes, while not participating when those indexes are negative for a given year. The power of this compounding, uninterrupted by negative returns, is very real. When taking the money out there is no tax, since it is a policy loan, so not income. The key is that while the money we take out is charged interest, that interest is paid by other cash in the policy, and the amount we take out will still earn investment credit. So, we play the arbitrage of paying interest of 5% on tax-free withdrawals and earning something above that close to 2% spread. Since I have been working with these. We are essentially just borrowing the life insurance chassis to take advantage of the tax benefits and thus efficiently design policies to have as little death benefit as possible before becoming a MEC, which is taxed differently. It is akin to a Roth IRA, but my clients and most of you on this forum make too much money to put money into Roth IRAs, and even so the contribution limits are really low. To buying huge policies in various efficient ways to provide tax-free liquidity to heirs upon death, or second death if a married couple. While the estate or gift tax exemptions are currently $11.7 million per spouse, it is highly likely these will be greatly reduced, perhaps even this year. Any assets over and above these exemptions are subject to 40% federal estate tax, which is due from the heirs 9 months later and must be paid in cash. This is where the life insurance comes. Instant liquidity to pay these taxes, so illiquid assets, real estate, closely held businesses don't need to sold to pay the bill. Some of my clients are working with attorneys to proactively gift some of their assets to dynasty trusts which are irrevocable and for the benefit of their kids or grandkids. Believing the $11.7 million exemptions will be reduced, they are using the exemption for gifting during life. This is complex with many moving parts, but a sound strategy for the right person or family, especially when gifting assets which will appreciate significantly, because those assets will now appreciate outside of the estate. For those assets left in their estate, we calculate what they might conservatively compound it and then make an educated guess where estate tax exemptions and rates might be, and then design strategies to ensure the liquidity will be there at the time the heirs need it. When the solution is life insurance, we often take advantage of low interest rates by borrowing at very low rates to pay huge premiums for short periods of time, typically 10 years. There are some great lenders making these loans, and since they are 100% collateralized at all times, through the death benefit or a combination of the cash value and liquid accounts, and thus lend at attractive rates, 12-month LIBOR plus a spread, currently around 2.65% right now. Most of my clients are wealthy and entrepreneurial and very focused on IRR. So while they could make huge premium payments, they prefer using leverage when it makes sense. In this case they feel good about using OPM, other people's money, in this case the banks or lenders, and having those dollars put into a vehicle which has comfortable averaged well over 6% for decades. Thus arbitrage. They often know what their own IRR is, meaning what they can earn by reinvesting in their business or real estate. So, not only are they very likely going to earn a spread of a few percent over their loan amounts, they don't have the opportunity costs of using large amounts of their money for insurance premiums and can earn at their own favorable IRRs. They do usually pay some amount for interest out of pocket, but it is very small as a percentage of premiums. Ultimately, the loans will usually be paid back from cash out of the policy perhaps 15 years later or so. In some cases, clients will write off interest on these loans by classifying them as special purpose loans for their company, but I let them decide that with their CPAs. I have heard arguments for and against this being legitimate, so I stay away from advising in this area where I am unqualified. For anyone still reading, I may have spurred more questions than providing answers. I would just caution anyone from expecting to use Google to find quality advice on any mainstream financial topics. The script, as would say, is to max out your 401k, use over-the-counter mutual funds or index funds, buy term if life insurance is needed, or whole life to be your own bank. None of what I do will be easily found in a Google search, and there is much complexity, including quality of lenders, insurance companies, client suitability, understanding risk, conservatively projecting, etc. I tell my successful friends or clients that they are the 1% of the 1%, the wealthy which they truly are in a global perspective, and to use solutions peddled to the masses easily found on the internet. B or C of SEO means they are missing out on ideas and strategies available to them because of their wealth and success. Whatever you do, keep an open mind and don't blindly accumulate and invest without factoring in income and possibly estate taxes on your future wealth. Thanks to MJ and many others for creating and cultivating this most excellent forum. Spoke in my best Keanu Reeves voice from Bill and Ted's Excellent Adventure.